Welcome back to the channel, guys. Some of you that are on X will have noticed an announcement from IncomeShares on an upgrade to the strategy. This was version 3 that was announced about a month ago on X, and I just wanted to cover off some of the kind of information around it, what it means. A lot of people not quite aware of what the changes actually mean for them as an investor. So part of me is to go through the two things that have been called out, the impact of it, why they're doing that, and give you a summary and conclusion as always. When we look at this, there are two changes that have come through now. One is the Decay Rule, and the second is the Option Tenor. And I want to break out two of those things separately and explain them individually, and then explain how they can work together as well to basically enhance the current strategy that we're running. I think he called this V2 on Twitter, but I think on the earlier post it was V3. So I'm going to call it V3. But first, I want to go back to the Greeks because it aligns to the Greeks a lot in terms of the understanding of these two things. So the first thing is the theta, right? And just to remind people that may not have seen the Greeks video or any of my other videos so far, the way to think of theta is the profit engine. It's the time decay. So theta is the rate at which an option's value loses value as time passes. So from an option seller's perspective, which is what we are in this case of IncomeShares, theta is a consistent kind of tailwind eroding the premium of the option sold, and that's generating the profit each day. So a real world example here, you sell a put option for $200 premium, a week passes with the market staying flat, the option is now only worth $150. You've made a $50 profit purely because time has passed. And so that's how theta is working for you. From another perspective, we also have gamma, which is the risk catalyst, and this is the accelerator. So gamma measures how quickly your directional exposure kind of accelerates. So from a seller's perspective, again, which is what we are, the negative gamma means losses can amount exponentially if the market moves against you, especially near expiry. And we saw this a lot in the earlier strategies of IncomeShares, where it would blow through the strike. So a real world example here is, imagine we had an option expires today with the stock at the strike price. Even a 10-cent drop in the stock could cause you potentially to your losses from like $0 to $50 instantly. So that sudden extreme sensitivity to small moves is that gamma explosion. So what we want to do is try and minimize that once we've maximized the profit element. Okay, so that's the key elements to these things. So let's talk about the strategy upgrade number 1, which is the decay rule. So when a sold put option loses most of its value early, the idea is to close it, lock in the gains, and then redeploy. So basically open a new position. This rule transforms the strategy from a really passive one to a quite active one, and it takes that dangerous phase out of the trade almost, that time element. So the primary advantage here is mitigating gamma risk. By exiting early, the strategy systematically avoids the gamma explosion near expiration, preventing winning trades from turning into catastrophic losses. And as I said earlier, we did see that with IncomeShares, certainly when I think Coinbase was an example where we blew through the strike and we lost 1,000 shares, which was horrible to see. So this prevents that. The secondary advantage is once you've captured most of the profit, you obviously close that trade, frees up your capital, you can then immediately open a new position and start generating income again, enhancing those overall more returns from the premiums. So we can see how this one change alone is just so important from a strategy perspective. And we've been pushing IncomeShares to be more active. And for me, this is the first part of being more active. The other one is probably less understood, and this is the options tenor rule. So this is where the options expiry date now depends on when the trade is opened. So instead of selling the closest weekly option, the goal is to select the tenor that operates in the sweet spot of the time decay curve, maximizing profitability while maintaining a manageable risk profile. Just to give you a really high-level example of how this might work, theta itself isn't linear, it's non-linear. So as you get closer to expiry, the kind of acceleration is much more. So if we were to look at days to expiry is what DT is, by the way. So if we had a tenure of, let's say, 1 to 3 weeks or 0 to 21 days, your theta rate is very fast, your gamma risk is extreme, and the profile can become a bit unmanageable. If we had a tenure that was, let's say, 30 to 45 days, 4 to 6 weeks, the theta could be accelerated, the gamma risk would be lower, and it might be more of an optimal sweet spot. And then if we had a greater than 60 days, your theta rate is slow, your gamma risk is very low, but you're not going to get a huge amount of premiums for selling, and it might be quite inefficient. The other thing to bear in mind is that this will have to be adjusted based on the underlying or the security that's involved, because this is where the implied volatility also comes into play. So that 30 to 40 day window, that baseline or that sweet spot could shift based on the implied volatility. What I mean by that is a high IV security might offer rich enough premiums at a really shorter window. It could even be 1 week, 2 weeks. So again, take what I've shared there just as a kind of broad brush kind of thing, but just to explain the concept, but note the implied volatility is what will ultimately drive that sweet spot and them deciding what tenure they'd like to go for. So again, just having that extra flexibility is more about optimizing the theta rate and the gamma risk to get that balance. So if we look at the synergy side of things now, and we looked at this from a managing returns perspective, when we combine that tenor and that decay rule, it creates more of a cyclical framework that encompasses the entire life cycle of the trade. The idea is to ensure capital is always working in the most efficient and least risky phases. So as an example, we'll sell a put with 30 to 45 days to expiry. That's the data sweet spot for this particular underlying. We then harvest, hold the position. As it accelerates through that time decay, the premiums erode. We then say we're going to close this trade at 75% profit target, because that avoids the terminal risk now factor. Okay, so that's the other element of this. And then we redeploy the immediate funds and capital into a new trade. Okay, so we close the position, we open a brand new trade. Now that 75% profit, again, I think I heard Octave say it was 80% what they were trying to target. But again, this is just theoretical. They may change that even coming down to the underlying itself. So what's the end goal here? This has resulted in a superior risk return profile. So the integrated strategy transforms the return profile by systematically cutting off the source of the catastrophic losses, the left tail, as sometimes it's referred to, and then the enhanced approach produces more stability, reliable returns, ideal for more longer term capital compounding. And so we can see like this curve effect where you're going to get that more steeper peak with the enhanced strategy, whereas you're going to get this low waving from a strategy return perspective versus the probability aspect of it. So there you go, guys. Hopefully that gives you some idea of the version 3, as I'm calling it, change of strategy. There is a version 4 in the pipeline, as I understand it, where they're going to do more laddered puts. So that will give us greater flexibility, having different strike prices, ultimately allowing them to capture more. And again, it's just another way of managing the risk. So there you go, guys. Hopefully that was helpful. Let me know in the comments below whether that was helpful, whether you want me to cover anything else. I look forward to catching you on the next one. Take care, guys.